Hey traders, welcome to another episode of Forex Friday. Welcome, welcome. All right, great to see everybody. So we should be good to go. All right, let me just make sure. I think we're good to go. All right, welcome everybody. I appreciate the time. Let's get to it. A lot that has been going on. Of course, I've got the handy dandy little notebook. Um, so what are we looking at right now? And I think that there's something interesting about what's happening with the current condition of the dollar. There was a few things that we had talked about in the last episode. And really what we want to cover here, hey there Clint, great to see you. We want to cover today is the US dollar. Taking a look at the current correction we saw yesterday. Yesterday was one of the larger corrections we've seen since May, I believe, in the equities markets. And why would the equity markets have any kind of impact on the Forex world? I mean, I've always talked about the sheer size of the Forex markets and the fact that when you're trading Forex, Forex usually is the dog, everything else is the tail. But sometimes, gang, the tail does wag the dog. And when it's able to do that, it's going to be because of the sheer size of the move or the impact from, usually the equities or commodities side. So today, and I didn't realize when I was doing some of the notes to prepare for this session earlier in the week, I'm looking at my notes thinking, yeah, this may not be necessarily what we're going to talk about today because of that equity sell-off yesterday. Now, one of the things that I remember seeing earlier this week and fairly persistently, not that it's any kind of foreshadowing guarantee, but the fact that yen strength, we call it yen revenge in the simpler futures room, yen revenge. And yen revenge means if the yen is persistently strong, we'll oftentimes see sort of an erosion of support and ultimately a correction or a move lower in the equity markets. And so ultimately, if we see consistent yen strength, let that be something that will at least give you a heads up to potential weakness on the equity side. So I'm kind of coming at you today in our Forex Friday from somewhat of a stock trading background. And I'm always interested, and feel free to let me know, I'm always interested in how many of you are multi-asset class. That's not technically the right term, but how many of you are stock traders, options traders, futures traders, and of course Forex traders? So in a lot of ways, if we were to look at a hierarchy, so to speak, kind of looking at things from heights, right? The viewpoint you have from different heights. One of the things I would say is the Forex markets are your your stereotypical 40,000 foot view. Only because the markets or the Forex markets are impacted by the largest factors that can affect any market. That's the central bank. So you've got this pulse on the central bank and the pulse on economies and the currencies of those economies via Forex. So if you're starting with a Forex point of view, you've got a great point of view. Well, Forex, of course, then invites commodities. All right, so again, if you're kind of thinking of this as a sort of as a funnel, at the very top, kind of at the widest part where we're pouring everything in, you've got central banks, you've got commodities, you've got equities, you've got news and whatever. So if we're kind of following along the same idea, once we start with a 40,000 foot view of Forex, we can kind of go to the 30,000 foot view of futures, second largest market, again, kind of cumulatively in the world. Now, Forex and futures have a lot in common. Some of you may know that if you've joined me before in the Simpler Futures room, if you've checked out simplertrading.com and you've joined me there, you know that I never separate the two. In fact, specifically in previous episodes, we've talked about the COMDOLs, Australian dollar, New Zealand dollar, Canadian dollar. And when we have moves, like we saw yesterday in the equity markets, a lot of you probably noticed, wow, that Aussie pulled back big time while the yen was very strong. I think I remember Raghee talking about this. Strong yen, typically weak markets, COMDOLs, the Aussie, New Zealand dollar, Canadian dollar, weakness, that's typically reflecting weak stocks. All right, or stonks as I've been calling them lately. So when you have that push-pull, or you have that contrast between the, let me put my little notebook away. When you have that contrast between the com dolls and the yen, what you end up seeing is really more dramatic movement and follow through and organization and clarity on the equity side. So if you're, again, a multi-asset class trader, you embrace multiple asset classes, Forex, futures, stocks, options, you'll start to see the connective thread. So we've gone from Forex to commodities, largest market to second largest market. We know the commodities affect Australian dollar, New Zealand dollar, Canadian dollar, specifically anything that's mined, your iron ores, your gold for Australia, dairy products for New Zealand, and crude and energy products for Canada. So do we think that commodities are in play when equities move higher and lower? Absolutely. Partly the reason why is, think about people's outlook on demand for commodities in the assumption of an expanding economy. Stocks, we know, are not, and if you don't know this, let me tell you now, stocks are not a reflection, especially right now, and they have not been for many, many years. Stocks are not a reflection of an expanding economy. Lately, they've been a reflection of an expanding Federal Reserve balance sheet. Okay? I'm not being sassy. It's fact talk, not smack talk. All right? So typically, though, there's still sort of this expectation, there's still sort of this connection, correlation, if you want to call it that, to where if equities are up, com dolls and certain commodities are also going to be higher. Case in point, check out the way in which copper has been moving since the equity markets are rallying. Do we have growth and expansion in any economy? Hardly. I mean, we're reopening. So they went from this to now this. That's not moving higher still. So, but copper's moving higher with the equity markets, regardless of the fact that we can't really say manufacturing and those types of things are better than they were, say, in October of last year. But nonetheless, copper's tracking with stocks. We also know the Australian dollar tracking with the reopening, tracking with stocks. So those of you that are in the Forex Mastery, and by the way, you can check that out at simplertrading.com/Forex. One of the things we talked about in the Mastery, and this is about 3 weeks now, is really embracing the strength of the Australian dollar and slowly and somewhat painfully letting go of the strength in the US dollar. In fact, as of 2 weeks ago, we let go of the US dollar strength and sort of focusing primarily on Australian dollar strength, New Zealand dollar strength, a little bit of US dollar strength, some pound weakness, things like that. But by far, your best driver, your leader to the upside is the Aussie dollar. So we've talked about contrast and strength and weakness before. We know why the com dolls are strong. We know the Australian dollar is leading the way in terms of com dolls. And we also know that ultimately this is attached to the equities story. So I might say again, going back to what we talked about earlier, mostly the Forex markets are just really not that moved by equities unless it's earnings and massive volatility and movement and impact, or significant trends. Or in this case, again, as I like just to simply have to call it, this is the tail wagging the dog. So as long as the equity markets are moving higher, we're probably going to continue to see that kind of com doll strength and continue to see yen weakness. So, Aussie yen, New Zealand dollar yen, Canadian dollar yen. And in the mix of all this, some of you might ask, well, what about the dollar? What about the US dollar? I don't believe the dollar is done. I don't believe it's in a downtrend either, but it's certainly very difficult to be long the dollar. Because then the question begins with, well, if I want to buy dollars, what is it stronger than? Very, very little. Going back to contrast conversations we've had in previous episodes. If I want to buy dollars, I want to find something weaker. I want an unbalanced scale. I don't want a balanced scale. Balance between two currencies means that the pair is going nowhere, right? Balance, nowhere. Keep that in mind. When you have the imbalance, think about the imbalance as a trend. Think of the imbalance as a trend. It looks like I'm doing a dance on this video now, but think of the imbalance as a trend. Hey there, Deborah. Forex only for now, Paul. Cool. I think if you are open to other markets, having started with the Forex market's a really smart decision, and then expanding becomes a really natural, easy thing. I actually, for those of you that are curious how I started or what my sequence was, and it was utterly accidental, it wasn't planned. It just was a function of the fact that I had a lot of IBM stock. As a kid, my dad had given it to me. He was a lifelong IBMer, so I had IBM stock. And I learned very early. A My cousin of mine had said, I call him an uncle, but he's actually a cousin. He hates it too, makes him feel old, which I love. So he taught me how to write covered calls because you've got this IBM stock. Do you want to learn how to write covered calls? Yeah, I definitely want to. He was also the first one to, where I heard that beep, wee, kind of the noise for the dial-up internet, which opened my mind to what was possible in terms of retrieving information and engaging with the markets. But that's maybe a conversation for another time. So I was writing covered calls, and kind of around the same time, I was also playing commodity futures. You might say, "Wow, Rog, you didn't start with Forex." No, I started with writing covered calls on IBM stock that I owned, and I was playing futures. And the reason I played futures is the leverage was beautiful, as it is in Forex. I could take a very small, amount of money, very small grub stake, and because of the leverage, I could trade. And back then, I traded corn and wheat and cocoa and sugar and things like that. And for a lot of folks, they might say, "Well, where's Forex been?" Remember, gang, in the U.S., Forex only been around since late '99. Let's just call it 2000, the year 2000. It's not been along very long because it wasn't legal in this country. It's been around in other parts of the world. Other parts of the world, people talk currencies as fluently as we talk Apple, Microsoft, Facebook, and Google. I mean, it's just part of their day, especially pre-Euro. I was trading currency futures and Forex, and this was currency futures pre-Euro, and you better believe different countries knew the exchange rates before the single currency. Anyways, that's neither here nor there, but if you start with Forex, you go to commodities, you see the connection, Comdols, commodities, then you get to equities. So again, certain stocks have the ability to move the Forex markets, which sounds crazy, but it's true. Not all currencies, right? I don't think the euro is really that interested in what's happening with Apple, but Comdols and the yen may be. So as we roll into the next earnings season, I have earnings season tactics that I use to better trade the futures indices. But believe me, earnings are going to affect the yen, the Australian dollar, the Canadian dollar, even the New Zealand dollar, to the extent that the Aussie yen, which has often been, well, first of all, the most popular carry trade ever, because of the historical, not currently, but because of the historical percentage contrast between the two. What do I mean by that? If the Australian dollar rate for the currency, the central bank rate, the fund rate, is high, and we know that there's been a chronically low rate out of Japan for decades now, what a lot of traders do is they'll capitalize on and profit from the difference in the percentage rates. So that's what I mean by the contrast, or the difference in the percentages. Whatever the Australian dollar yields, let's call it 2.5%, it's yielded far more than that. It's yielded upwards of 4 or 5% in the past. And so if you can buy Australian dollar, preferably while it's in an uptrend, and sell or borrow, right, use yen to purchase Australian dollar, yen is insanely inexpensive. It's been 0.1%. You've instantly got a 2.4% interest rate differential between the two currencies. Well, that's one of the reasons it was always a very popular carry trade. But of course, remember, the expectation is Comdols are reflective of economic expansion, stock market strength. It's very common to see traders sell, borrow yen to fund the purchase of higher yielding asset classes, like stonks. Okay, so Aussie yen just sort of historically has this connection to the stock market, where the stock market's up, typically the Aussie yen as well, and if the stock market's down, the Aussie yen goes with that. It's not as tight as it used to be. There's still sort of leftover remnants of that type of correlation, But the reason it's fallen off is because the interest rate differential continues to narrow. The Australian central bank rate is much lower. The yen bank rate is lower still. But if you look at historical central bank rates, you'll see, the carry trade becomes less and less relevant the less there is a difference between the central bank rates, which is, quite frankly, where we are right now. All right. So I do want to take a few questions sort of as we wrap up here. And hey there, Naveen. For my Forex Mastery, since I'm looking for, I look at, so for the Forex Mastery, it's Forex. Naveen, thank you for the question. I like to talk, today I figured I'd talk a little bit about futures and equities because the move we had yesterday. It was a pretty historic move. Heck, the move to the upside to the NASDAQ 10,000 level was historic. The pullback was fairly historic. So I thought, let's talk a little bit about how Forex, or if Forex even does have any kind of connection to stocks. So I'm looking at futures, of course. You can trade some currencies via the futures markets. But can you use CFDs? Absolutely. In fact, I envy you. I think anyone who's got the ability to use CFDs has a tremendous edge. Absolutely. Absolutely. So yes, can you use CFDs? The thing that I'll mention is on the Forex side, you have basically every possible combination of currency pairs. In the futures, it's limited. So you're probably going to be somewhere in the middle with the CFDs. But you've got such terrific tax advantages with the CFDs. And terrific liquidity. Gosh, I wish we had CFDs. By the way, for those of you that are wondering, what is a CFD? I'm in the US. I've never heard of it. You won't, because we don't have access to it. It's called a contract for difference, and it's amazing. They're amazing tools. I like. Oh, Paul. Oh, I found that it was in the closet. No, don't buy it. Don't buy it. It was my most. It was my last book, and I had a lot of fun writing it. It's probably my favorite. Got some cool cartoons and stuff in it, courtesy of FX Street.